Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning. It's not good morning, man. It's afternoon for pretty much everybody, right? But hey, we got a Federal Reserve meeting. So I don't see any reason for this Federal Reserve meeting to be all that special. We're not getting the economic projections this time. We're not expecting a change. So this one is going to be mostly about what Powell says in the presser. But for some unexplainable reason, the market is pricing in more volatility for this FOMC than usual. So market seems to know something I don't. And you can see over here, liquidity has pulled. Treasuries are pulling down. So they're pulling early. Market really is expecting this to be a blockbuster event of some sort. So we got about what, 3 minutes? I think we can just kind of relax for now, though. A little bit of some order shuffling there, 42.29. I think that they're just messing around, though. Okay, so no change. We'll see if there's any significant change in the statement. So far, Treasury market not really responding. Let's see here. Instead of saying job gains have slowed in recent months, it says job gains have moderated since earlier in the year. That's pretty much it. Well, the 30-year is taking off here. Japanese yen spiking hard, dollar falling. No, you didn't miss it. We just barely got it. this reaction is these ones are always the funniest, right? Because the real event is the speech in 30 minutes, but there's a pretty big whipsaw off of it, anyways. It seems like some people are making this bet that like we've reached the end of the cycle and now is the time to buy treasuries, but it seems kind of silly to place it here now, but whatever. People gonna do that. Traders gonna trade. What you gonna do? Definitely gonna keep my safeties on here and the account off because that was a pretty decently wild jump there off of nothing. So, and liquidity is still really light in the treasuries as well. Well, the biggest jump that I see, it seems like it was in the Japanese yen. It's a really big jump in the Japanese yen, I think. Well, a little bit up again. So let's see here. Like, before the news, we were 22.5. So I guess we're only just like a little sneeze higher, but. My ear really itches for some reason. Okay, the 30 years is settling back down to where it was, but the others have not. So we have seen some additional steepening. Getting a headline that the House Speaker is seeking a stopgap bill that will keep the government funded through January. Wonder why only until January. Okay, few ticks down there. Let's reset a few things. Yeah, well, Raymond, we have a Federal Reserve meeting today, so we usually stream the Federal Reserve meeting. Basically, during my lunch. There's a little fly in here. Maybe I might need to do some more checking of the plants over here. I'm curious to see if the treasuries revert back down after this. Does the steepener that we just got stay in? In other words, the 5-year comes back to where it was around 267, but then the 30 years is substantially lower than where it started. Someone in Discord is noting that there's some buying in the 2-year. Yep, we're live. I mean, I haven't taken any live trades. But we're live. Wait, is the stream going? Is the stream not going? Wait, are you, any of you, none of you have responded to me. Oh, okay. Raymond says yes. But is he responding to me or Walter? Oh, you're not? Okay. No. This is live. Okay, we're good. Marco. I see you guys are so slow. It's been 5 seconds. Okay, Walter says that he can hear us. Oh, Brad, hey, how have you been, Brad? Okay, so look, the treasuries did come down, but the steepener is unwinding a little bit. Curious. You thought it was a replay? Yeah, you know, I'm not really a fan of the way that YouTube does this. I mean, it's better. I like that now that they teach, they treat live replays separately from other content. That's good, I guess. It seems to send people more to the videos that I would like them to see. But I don't know. There's not really like a very good way for it to be like, this was today's and this was yesterday's. I mean, it really is one of those things where it's like, after it's done, I don't see why anybody would watch it, but it's there. I think that they do have, I have had times where I'll go back. It usually takes me a while to find a video, but I'll go back and find a video and I'll be able to find important insights from it. You know, like a video from several years ago, but man, so much content. What do you think about it? I like that it showed you that we were live, though. That's good, right? Coin had quite a spike today too, by the way. Just noticing earlier in the day. Spike and then fell back down. I wonder what that's all about. It seems like the market's going down. I think that you had a bunch of people, for whatever reason, traders going to trade. I think that what you're seeing right now is the people that, and robots and so forth, that kind of all got in on the knee-jerk reaction, giving them up now. And I expect that we probably continue to just kind of slowly revert back to the price from before the news until the press conference. Once the press conference gets going, you might see some wild stuff. Yeah, I don't know. It's usually the case that I'll be like, I don't really see what was such a big deal about it, what he said. I think that they're latching on to something that's not really that significant. But the market will move. It will move. So people are putting orders in. It doesn't matter why they're putting the orders in. It's going to move the markets. And you've got everybody sitting out there with their finger on the trigger finger. There's probably going to be some volatility. Yeah, I will pump the press conference in here so you'll be able to hear it. Because again, it's a lot of it is about the having the historical record. So we want to be able to, when we rewatch it, see what Powell was saying without having to compose it together ourselves. Outright looks bullish. Trader's gonna trade the mug. Get your trader's gonna trade mug now in the video description below. That's need to work on the one. I need to get together with an artist. If you know an artist that is like makes a lot of like a really detailed fine line kind of artwork, let me know. Let me know and I'll. So I have a shirt idea that I think you guys would love, but they need to make it that shirt. Okay, so there was a little bit of another leg lower, and again, the steepener that appears to have been on since the release is reverting now. What's this? Are we getting some new? I just didn't clear my notifications. Pikachu Solu? Do I know you? That is a weird name. I think this is the first time that I've seen somebody in chat with a Pokemon name, so. I was looking at the 10-year and thought it was the S&P 500. Did you guys watch the series finale of Pokemon, where like Ash becomes Pokemon League champion and like it's the end of the story or whatever? And there was like the last time that you saw Jesse and James. Oh my gosh, good stuff. It was pretty good. Like if you watched it as a kid, go back and watch it. You probably appreciate it. I keep trying to get my kid into the Pokemon, but he continues to be not that interested in it yet. I'm sure it'll come eventually. Well, now that you told me, I'm not watching it. All right, that's fine. I should recommend a bunch of other things to watch that are like some of the best things you'll ever see, so that Walter misses out on all that culture. Well, some markets moved more than others. It really looks like the treasuries and the Japanese yen like way overreacted to this, but the equity markets, gold and silver, all kind of fairly sanguine, as we should be. The oil market has been selling pretty much all day. And yeah, I don't know if that was really reacted to this at all, but like, you've seen the Endgame and what? Well, how can you have not seen that one? Dude, the Marvel movies after Endgame have just been so ugh. Gen Z is all about One Piece, no respect for Pokemon. Really? Wait, really? They like One Piece. Is One Piece a good show for younger people? I've never watched that one. You know what? On TikTok sometimes I'll see videos where they're trying to talk about the lore and world building of One Piece, and I just find their whole world to be so silly and dumb. I can't really take it seriously. Whatever. Have you seen Titanic? I was never, you know, as a straight male, I was never that interested in Titanic, right? It's so weird to watch that show now and see Leonardo DiCaprio when he was a teenager. Oh, man. Okay, there's 22. So let's reset. I'll clear the middle. Well, no, I'll leave the middle on here. Why? This is, you know, the cryptocurrency community has been really irritating me lately because, like, oh, Solana is one. Okay, have fun with that one. That totally worked out great last time Solana took off, right? Oh wait, this is one we should look at. We should look at the chart of this one because the Solana mess, that one was ugly, wasn't it? Let's see here. We'll probably look at CoinMarketCap. Well, let's look at the biggest winner. 20%. Okay. You know, it's still the number 7 coin, so that's not terrible. That's not terrible. A lot of cryptocurrencies have been kind of moving up with the cryptocurrency market, though. So when I start to see that, when I start to see like the altcoins going with it and everything, like something has changed in the Bitcoin market for sure. But let's see here. I think we need to go all the way back to, oh man. Oh yeah. Let's see here. Yes, it was 250 at one point. Oh my gosh, but look at that. That rice is so ridiculous. Oh, and it come back almost as fast. Jeez. Listen, I don't want to hear about any unless it's garlic coin. If it's garlic coin, then like we can talk about it, right? We already talked about garlic coin today, didn't we? Well, 20% isn't terrible, is it? Oh, look at that. Oh, no. Did I have an impact on it? Because we talked about it this morning. We talked about garlic coin this morning, and it looks like somebody pumped it to 24 cents. But it came right back almost as quickly, so. Okay, so garlic coin was a meme coin created for the purposes of being a meme on Reddit. So there was a subreddit with a lot of subscribers, and they had like an airdrop when it came out and all of these sorts of things. But it's a shit coin. Like, I think that a large portion of the original thing was like pre-mined and rug pulled. So like the rug pull already happened. Then there was issue with like a miner on there and everything. But it did, if we kind of come back out here, in 20, well, let's see here. Yeah, it was. In 2021, along with the rest of the cryptocurrency market, there was a point at which it was 10 cents. So yeah, it's just, it was. I think that it would be fair to call garlic coin a scam coin. I mean, I wouldn't call it. It's not a scam coin anymore, but I think that what originally like got it going was kind of a rug pull scam, yeah. But that's what's so effing great about it here, right? Is that like it's like the shittiest of shit coins, and the supply is so low. There's only 69 million coins in existence. That if it ever takes off, it'll go. I mean, like if garlic coin actually catches public interest, it'll be worth like $1,000, not 2 cents. So unlike Dogecoin, which is like always, they're always minting more and more and more and more of it, so it just becomes more and more useless, right? Garlic coin is like the opposite of Dogecoin, is the way I think of it. We should probably pull up the Federal Reserve meeting now, huh? YouTube.com/Federal Reserve. Press conference. Okay, here it comes. So let me turn the well, I'll leave the music on.
Good afternoon.
Just turn the music down a little bit.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt.
I feel like this should be a snoozer meeting, but
Interest rate unchanged.
There's 4 or 5 ticks up there.
Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing economic.
See, this is another one of those, like, okay, they moved up 6 ticks.
That economic activity has been
I didn't notice anything in that was interesting. Did you?
earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of
S&P 500 moved a little bit more on that little run than the rest,
although the jobs
or than the initial move, let's say.
Labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal.
I know there's a lot of times that I don't know why the market moves. Yeah.
Total PCE prices rose 3.4%.
Well, like I said, every day trader is basically out there sitting with their finger on the trigger finger looking for a reason to buy it. So it's almost inevitable that it moves.
Inflation has moderated since the middle of last year, and readings
Is that a wall at 42.50?
but a few months of
It's a little bit of a wall.
of what it will take to build
I wouldn't pay too much attention to it. It is just up there at the highs and probably is liquidity that kind of got left behind when we pulled back from that price.
a long way to
We could very easily just slip right through that.
term inflation
700 contracts is nothing.
well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective.
Did they not like that?
We are attentive to recent data showing the resilience of economic growth and demand for labor, evidence of growth persistently above potential, or that tightness in the labor market is no longer easy. Could put further pressure.
Hey, thanks, Professor. If you guys haven't watched like my VOD videos, you should go and watch them. I'm really proud of the content that we've made here.
In recent months.
Spent a lot of time making them. Good information you're not going to hear anywhere else, and that is empirically backed.
Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the
They
uncertainty,
didn't like something that he said there, but they recovered it real quickly.
carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return 3% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential
Talking about
and some softening of labor market
Yeah.
conditions. Restoring price stability is essential
Hold on.
to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission,
I haven't been to the channel in a while.
everything we can to achieve our maximum employment and price stability goals.
Oops.
Thank you, and I look forward to your questions.
So you just come to the page.
Howard Schneider with Reuters. Thank you.
So
To what you referenced,
this one right here,
bond yields
inelastic market,
action by the Fed at this moment.
that's like probably the best video. That one and proven market behaviors. Those are the two best videos on the channel, in my opinion.
Talk about bond yields, but I want to take a second and just sort of set the broader context in which we're looking.
So I have this. Oh, hold on a
If
second.
you
I
look
can
at
get
the
it
situation,
off.
let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures.
So, anyways, I have this like start here playlist
Many forecasters
that is like if you're a complete beginner. So like you need to pick a platform and all of those sorts of things. There's a lot in here, right?
achieving a stance
But then the other one, the order flow.
sufficiently restrictive to bring
This is the one that's there's like 5 or 6 videos in it.
yet.
I think there's another. Yeah, there's 6 videos in it.
So that is the broader context.
This is the playlist. Like watch this playlist.
Economy and all the things I said. That's the context in which we're looking at this question of rates. So
Yeah, Jigsaw has a lot of good stuff.
obviously we're monitoring, we're attentive to the increase in longer-term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from
All of a sudden, I can feel something in the back of my throat. I don't know what it is. It's
and lower equity prices
really ick.
could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes.
Okay, so this move,
The thing is that the
what they're saying here is okay,
simply be a reflection
tighter financial conditions
of policy move.
have been doing the Federal Reserve's job for us. But if those tighter financial conditions don't persist, then the Federal Reserve may have to raise rates again. They didn't like that.
that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And, the mind's eye goes to the 8%, near 8% mortgage rate, which could have, pretty significant effect on housing. So that's how I would answer your question.
That's
Following, to be clear on this, in your opening statement and just now, you seem to imply that you are not
Jeez.
confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't. We're not confident that we have. And that is
we're not confident that we haven't, but we're not confident that we have.
meetings is to be, just
You can see the market being upset about that one.
further policy tightening that may be appropriate to return inflation to 2% over time.
I could probably pull a tick out here. You want to try? This is dangerous. I feel like this is I feel like what I'm doing here is a little bit risky.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more
Okay.
extended
Built. Yeah, I'm not liking that.
So let me start by saying we haven't made a decision about September. You're asking.
It's not terrible, but not favorable.
We're going into this December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity, And so we'll be taking, and also the broader situation, the broader condition situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We have.
No, I think I'm going to say that one didn't work.
I would say though that the idea that the idea that you would be difficult to
Ouch.
raise again after stopping for a
let's
meeting
keep
or
that.
two is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to publicly say in the minutes. You'll know anyway in the minutes. The staff did not put a recession back in. I mean, it would be hard to see how you would do that if you look at the.
That's funny. I've never heard him say that before.
It's not really
It's like,
indicative of
Nick,
recession.
your question was too good.
Interesting, about translation into rate hikes. I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was precise would hang out there and have a great chance of.
Are you familiar with icebergs? Yes.
I think what we can say is that financial conditions have clearly.
So we'd seen like right there at 19.5. That was probably an iceberg when it happened.
Businesses are paying now, and over time that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter. What makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
It's, the way our policy works is, and sometimes it works with lags, of course, which can be long and variable, but ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now.
So did you see what his answer to that was? So how are you confident? It was like, well, because that's what we do, and if it doesn't work, then we're screwed. That was basically
reports from housing that
my takeaway from that one.
be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we just we take it as it is.
Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence.
Well, neither of these two attempts that I've tried here are really working out.
The recent easing
So-
of labor market tightness, that seems to suggest something more powerful.
These are
than
just
one more quarter
Sim trades playing around. So
necessary, and I'm just curious if that's how the committee sees it.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture, and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth. We look at growth insofar as it has implications for our two mandate goals. We look at that. And we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay. And just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So it's the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently.
Do you think that mentioning Solana on my stream is going to help it or something? I don't.
Then you just said that
Why are you bringing that up now?
Would you say the bias right now is neutral? That there is no disposition to hike again, and that the committee largely has moved off of this?
Why am I so lucky as to be the target of your Solana promotion?
No, I wouldn't say that at all. I would say, the language,
look at that.
in determining the extent
Seth likes that.
that may be appropriate to return inflation 2% over time. That's the question we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more?
Steve!
It's not, and that is the question, and you're right.
You're screwing it up, Steve. Just shut up. Come on.
And we'll write down another forecast, as you know, in December.
Thank you. Chris Rugaber at Associated Press.
I don't think he liked that question.
Well, since the last meeting, the auto workers' strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic.
Pushing higher. It seems like they want higher. So let's flatten this.
Appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation, and we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy.
I just bought $65,000 worth of Solana because of a random YouTube comment.
In the face of
Uzi,
offshore.
you could have just bought $65,000 worth of garlic coin,
City, I think.
and then
What you hear, and is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling.
I ain't trying to you.
People who were feeling it in their home lives as well.
Did you catch it earlier?
Particularly
Like
people who
after we talked about it on the stream this morning, there was a
their incoming
0.4 of a cent further increase in it.
the essentials of life. So we know that.
I'm suspicious.
New, but
Like seriously, all it takes is a few $100 to move garlic coin. Like it's absolutely ridiculous. If you put $65,000 into garlic coin, it would be worth it would probably be up to beyond 3 cents now. Like,
fully restore price stability.
it's ridiculous.
Do it as quickly as possible, but also with the least damage we can.
Hi, Chair Powell. Washington Post. Thanks for
That would be a 33% gain on the day.
pain that would likely be coming for the economy in order to get inflation down.
I think it would be way further than that.
Rate hikes in ways that would normally be expected.
60, like, let's say $50,000 to keep them to whole numbers. $50,000 would have such a significant impact on the garlic coin market that I wouldn't be able to estimate it. But it would be well over 3 cents. And if you get it well over 3 cents, then everybody starts like picking up on it, right?
Typical of rate hiking cycles like this one. So that's a historic.
People would start talking about it again, basically.
Welcome result. And the same is true of growth. You know, we've been saying that we need to see below potential growth, and
make everyone start selling it. Yeah.
We're still seeing this. I still believe, and my colleagues, for the most part, I think still believe.
Well,
it is likely to be true.
If we did get up there, I don't think that I would be able to sell it. No.
Some slower growth and some soft.
I honestly.
To get
garlic coin would need to be listed on a larger exchange for me to bump my position.
And I think we know why. You know, since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover.
But I don't think of it as like
two forces now
I can finally sell this garbage, because to me it's like
that first one
I got it for free basically.
Without
so like I can be patient if it goes up and then I'm not able to get out, or that's fine.
Supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side, gain that is really helping the economy, and it's part of why GDP is so high, is because we're getting that supply. So we welcome that, but I think those things will run their course, and we're probably still going to be left. We think, and I think, we'll still be left with some ground to.
Or you pull one of those YouTuber ruggings that.
That's where monetary
never. I hate it when it covers up what you're saying.
Still going to be important.
Against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline, and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the
I remember that.
Of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out.
Oh, no, I mind it. That wasn't given to me. No.
Next year.
I guess technically I did spend money on it, right? Because
to get into the
it costs me on my electricity bill, but the computer is on all the time anyways, so I don't think it really had an appreciable impact.
I think trying to make a
Logan Paul gets away with it, so it's like I would never do that to you guys, right?
And this is one of the reasons
I don't think, even if I was trying to do that, I don't think that you guys would fall for it. So
policy time to get into the economy. And it takes time, we know that, and you can't rush it.
Okay, so I think here's a spot where I can kind of try and do this now.
Of how much more we need to do, if we need to do more.
Yeah, I would never buy some stuff up that people on YouTube tell me to buy. Yeah.
Michael McKee from Bloomberg.
Well, I've fallen down the rich list, but I mined garlic coin every day for like 2 years. So
had always said
I mined a lot of it, okay?
Than trend growth. Has that changed? And two, it sounds to me like
I mined enough that if garlic coin
every meeting is live with the
took off,
a rate increase for
or let me put it this way, if I had the ability to have sold when it was up at like 20 cents,
whether or not
it would have,
tightening in
The thing is that somebody did sell up there,
subjective.
and my impact would have been as big or bigger.
Well, so let's talk about the dot plot first. So the dot plot is a a picture in time of what the people on the committee
One piece of financial advice: ignore YouTuber financial.
policy in light of their own personal.
Well, there are some creators on YouTube that will actually give you good stuff, but like for trading, yeah, it's
Plan
you know, I'd say all social media.
forecast that
YouTube is the worst place to get such advice.
cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we
Could be good for analysis, maybe.
my colleagues and I will be talking about how we're processing that data. In terms of, we're not really
Okay.
in terms of growth. What I said was below potential. So what you have here recently is growth that is
So a big stack there, 27. A little suspicious.
is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth.
Orders aren't really reacting to it either.
Trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%.
This is a perfect example to see how these kinds of shenanigans go. I think that somebody is trying to shove it to the highs, though.
Through both participation and immigration, and with the better functioning in the labor market, and with
He got filled and they took it.
chain and shortages and those kinds of things, you're seeing
Okay.
actually elevated potential growth. There's catch-up growth that can happen in potential, and that means that if you could be growing at 2% this year, and still be growing below the increase in the potential output of the economy.
Oh, you're right. That probably is a bit close.
That's why I would say it as
We
below.
still got 30 seconds, but
Clarify what I asked about the, meeting by meeting. Are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective
wow.
criteria rather than objective at each meeting?
I mean, I don't know that I want to just accept anybody's characterization of it. I'll tell you how.
I love it.
Asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including conditions and all of those things that we look at, and then we've
I like his style today. Yeah, it really is like
very far. And
he's getting good at this, right? He's been at it for a while now. He's starting to get good at it.
spread of people think
I
one or
think
two
so.
additional hikes. So you're close to the end of the cycle. That was an impression as of a belief as of September. It's not a promise or a plan of the future. And so we're going into this one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So, committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering.
So I'm going to change these.
I know there are many candidate
Okay,
explanations.
there's a big order there that canceled at 27.5.
QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not. I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the proposal, and you yourself expressed some reservations. And I'm just curious, Could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, until well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to we're a consensus-driven organization. We'll come to a package that has broad support on the board.
So broad support mean more support than the proposal had?
It means broad support.
I love how the journalists are always trying to go shoot for the moon, right? And he shuts them down every time.
When you look at long-term treasury yields, what else are you watching to evaluate how those tighter financial conditions are hitting the economy, and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but they're there are a few of the common ones that people look at. And so there are things like the level of the dollar, the level of equity.
So there's a little bit of iceberging there at 30.
Spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture, and they do play a role.
Kind of wondering if I should be trying to play this range now when I'm
standard financial conditions.
Uncertain.
Your second question was banking stress. So it's something we're watching. As you know, we did have there were issues with interest rate risk and also funding uninsured deposits in the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing. And
treasuries are still pretty active. So
that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Considerations there, what it would mean for merchants.
Okay, I don't like the look of the liquidity there now.
In terms of the use of both debit and credit cards in the payment system.
So you're right. We put a proposal out for comment is what we did. And this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do.
Yeah, that's a little
What else can we really do? It's a 90-day comment period. We typically don't comment on these things once they're out for comment, and we do hope that stakeholders, and we know that they will use this opportunity to express their views. They haven't been shy about that. So that's critical, and that's what I can say about that now.
Thank you. Thanks, Chair. Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
The progress is probably going to come in lumps and be bumpy, but we're making progress. I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the 2s, and the year after that further into the 2s. So that's if you look historically.
Having a little trouble getting that offer at 29.5 filled.
Comes down. It does take some time. And as you get, as you get further and further from those highs, it may actually take longer time.
I think it'll happen though.
The good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription.
Sheffield, that was 29.5, right?
And so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the bank term funding program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question.
Okay.
We haven't really been thinking about that yet.
Easy.
It's November 1, and that's a decision we'll be making in the first quarter of next year.
Great. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in one-year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation.
Feeling that sleepiness come over me now.
In winning the battle.
Ooh, I could that.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions.
S&P just breaking there, so I'm going to take a contract off.
You're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate.
We just got 2 slips in the SPOOs, so that it's kind of a warning to me that we might.
So, first thing to say,
get stuck here.
It's very important. It's a very important variable in the way we think about monetary.
Like the S&P 500 is creating a bit of a liquidity hole,
and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether our star has moved or not. Some people think it has. Some people haven't said that don't think it has.
Okay.
Ultimately, it's unknowable, and so really, again, what we're focused on is looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think, years from now, economists will be revising their estimates of R-star as it existed on November 1, 2020. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, but ultimately we've got to look at the effects of that policy's having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, they have wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back a couple, comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation so far. Although I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having inflation expectations, higher inflation expectations, become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although that we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is I think clearly restrictive at 5.25% to 5.5%. That
Oh, I'm sorry, the mic was off.
If you take off.
So I don't know if when I said this, if the mic was on, but this 107 evens, there's always a lot of liquidity at a really round number. And this one just seems like such an obvious target. It would be very unusual for us to get one tick away from it and then not trade it. So I think that I still have a really good chance of getting filled here. But that last little
what are you looking at?
3 ticks down is not particularly encouraging, right?
Well,
overall, though, I think like the liquidity behind me is looking okay. Actually, some of it just pulled.
Validating the path we saw over the.
I want to see that come back up over 3,000. Is it going to do it?
Now we've seen periods like that before.
There's a 25.
There hasn't been follow through. The data have bounced back. So
there you go.
Are we seeing inflation still coming down? So that's the first thing. Second thing is in the labor market.
And anyways, but I also am noticing that the Japanese yen is kind of coming up into some resistance, where
through just much more supply,
stopping just before its highs after the initial statement. So
very strong when you have the kind of job growth we've had over the last quarter. It's still very
not trading 107 even. There we go. There we go.
discussed, but coming down, in a kind of gradual way. I think
I should put a stop loss above break even.
set of processes.
Now it's not that time to talk about it.
CNN.
Remind me about that later.
Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be...
So now the question is, what should I do with this last contract?
We're going to be getting back.
Very, very easily in the green now, 422 in the green.
Clearly people are...
So despite 2 false starts, I was able to go hard on this one when I had a good trend, and it worked out for me.
Now wages that are
Liquidity and ES is terrible. I agree.
in the aggregate anyway.
Like especially after once we touched like 42.50, between 42.50 and 60, we've had a bunch of slips, and they're getting stuck here now.
Also at the same
essentially,
the pandemic effects are wearing off, so that goods availability, automobile or was
interesting that big old order at 31.5 now.
And from a business standpoint, there are more people to hire, and there's more labor supply.
So this is not one that I feel like I could jump on like with my live account.
It's been
but this has been a very solid trend up. Oh, it's only about 15,000 contracts long, but it's been a very solid uptrend.
Can that continue? And I just think the existence of this second set of factors at this time, which is the unwinding of the pandemic effects, that's what makes this.
There was kind of 2 spots where it pulled back a lot more than I anticipated, but now that 31.5 is actually getting over 4,000 dead points.
Longer for that process to begin than we thought, and we're still learning about how it plays out. That's all we can do.
So Daniel, the last question.
Thank you, Chair Powell. Daniel Avis from Agence France Presse. Just a quick question following up on an earlier one. With regards to the Israel-Hamas conflict, the Fed's financial stability report said the Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade and food.
I'm going to take a really nice nap after work today, I think.
Possible, surge in oil prices if
there's the big order pulled.
I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say so.
It's too late for what?
The question there is, does the war spread more widely, and does it start to do things like affect oil prices?
Did you guys forget that it was FOMC day today?
Price of oil has really not.
Did I not do a good job warning you?
As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects, and it isn't clear at this point that the conflict in the Middle East is on track to have significant.
Oh, it's too late to switch to the live account. Yeah, you know what? Every time that I trade the live account on FOMC day, I do poorly anyways. So, and you notice with this one, well, the first one I had 5 ticks against me. The second one I had 6 ticks against me. This one I got 7 ticks favorable.
Risk of that, and the war in Ukraine.
Although I think I started a lot lower than 29. I basically martingale it, right?
To commodities. So, thank you.
Thank you. But once I got something and I was in on a trend, I felt like I was pretty good in the flow. Like the places that I was putting them on and taking them off were pretty good. Oh. Can't Man, they sure ended it abruptly there, didn't they? Well, I think that I will take this last contract off at the evens as well, because I have to get my lunch hours over, and I should probably try and get back to it. Okay, there, it took me out. I think that was pretty good. You want to see? So you can see how terrible my trading was today. Well, I had one. I had two trades in the morning. One was just an outright loser, and then the other one was a bigger winner than the loser, though. So this one was just a little bit too early, is all. And this actually was plus 25, 30 if I had held it longer. Wow, look, they're extending here. Okay, so then there's these two trades, kind of bailed out of them before it got too far, and was able to let this one like really build up and run. So I think I can be reasonably proud of that. There was a couple of new people, so I was kind of like, can we show, some of the things that you're going to learn here that you won't pick up other places? That was really just more about execution and reading in the flow. But, something I want to point out is this liquidity hole phenomenon. So basically, when you get a liquidity hole, that kind of can make it difficult for price to move outside of that area. So do you see how when we made a liquidity hole over here in the S&P 500, that we then started to range across that range more frequently? Now we're seeming to get another leg higher. This leg higher is the end of the meeting. Okay. But I think there's still a good chance that we continue to visit like 42.55-ish area, because there's not as much liquidity. The market makers are kind of like nervous about this, pulling back on it. And that means it requires a lot more volume for them to really punch through and keep pushing up. So we might be a little bit more constrained here for a little bit until we come into the close, and then the liquidity will really come in a strong way. Well, it looks like they're still looking to push. One of the things that I'll always rail on is like these smart money concepts, scenarios, and so forth that are like, you breach a new high and then you fade that. I mean, it's a thing. Happens sometimes, but if you'd been doing that in the treasuries lately, you would be getting steamrolled every time, because these trends, they come through and they're just so incredibly strong. But when they need it, they take away more than there is, and so those trends will just go on forever. But anyways, a lot of it is, I'm not talking through it as much as I used to. Maybe I should be trying to do that and telling you here are all the little things. Like, one of the big things that I'll watch for, though, is the liquidity adding as we're going? And it kind of was. So it looks like there's a big player in the market involved here. You want to short the S&P but no opportunity? You see exactly what I mean here. The S&P is like coming back to 42.55 again. You can kind of use those liquidity holes as an opportunity to try and take a short, but you'd still have to have a reason to think that it's going to actively reverse there, right? Well, anyways, I should get going. I'm not going to wait until the close of the day. But sure will be fun to watch it in the S&P 500. And I think tomorrow will be crazy tomorrow. And then the non-farms on Friday, because we are very much getting this like. Oh, now you're completely lost. Well, there we go. We've done a good job. Well, the first thing that you need to realize is that the order flow is only one small component behind my decision-making process, right? Because what I've done is I've made the decision that it looks like they're going along. That makes sense with what I saw out of the FOMC. They're seeing it as dovish. They're buying. So then I'm just trying to find spots within that buying that would be like optimal locations, right? That's kind of what's going on. So that's how I was able to pull that off. But the real edge, the real key there was understanding enough about what was going on to know that it was a long. But yeah, go watch the videos. This is good stuff. I'll catch you tomorrow. In the meantime, stay excellent.